This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this update on the Hennessy Mid Cap 30 Fund are portfolio managers Ryan Kelley and Josh Wein. We're going to review the fund's investment strategy, discuss the most recent rebalance, and highlight a few fundamental drivers of the portfolio. Let's jump right in. Ryan, let's start with this. What is the overall investment strategy for this fund?
Well, the investment strategy is pretty simple. We want to provide acceptable returns for our shareholders over a complete market cycle. We do that by investing in 30 stocks only in the mid-cap space that we buy and hold for at least a year, for a minimum of a year. We rebalance once annually, usually in the fall, and this helps to reduce turnover. It also helps to reduce overall transaction costs for our shareholders as well. What we're trying to do here is when we buy a stock, we use a formula-based investing. We're looking to combine value investing with earnings growth and stock momentum. And this helps us to basically identify the 30 best stocks to go into the portfolio. We purchase them all equally every year when we do the rebalance. So they all come in at about a 3.3% weight. But throughout the year, we let them run. So if one company does very, very well, it's going to be 5 or 6% of the portfolio. And then the opposite is true if a company doesn't do as well. We find that doing it this way, it helps to take some of the emotion out of investing, to really allow stocks time to perform, to stick to a good methodology that's based on time-tested fundamentals. And it allows us to really sometimes catch either undervalued stocks or even undervalued sectors that are turning a corner, and then allows us to basically participate in the upside.
And so, Josh, when you look at the fund today, what is the composition?
Yeah, the composition of the Mid Cap 30 Fund, Ryan mentioned equally weighted. So there are 30 names in the fund, each at about 3%. The biggest weighting is industrials. It's about 36% of the fund, followed by energy, which is the biggest overweight in the fund, and then consumer discretionary. Those three sectors comprise about almost 80% of the fund. So we are exposed to 8 of the 11 GICS sectors, but certainly, without a doubt, there's definitely some concentrated exposure within 3 key sectors that we think, make sense, given where we see the economy right now and where it may be going.
So let's dig into the sectors. Ryan, with the energy sector having the most significant overweight compared to its index, what do you think has driven that in this rebalance?
Sure. I think primarily it's based on valuation. A lot of these stocks have moved in the last couple of years. We're in a much different environment now with oil and natural gas at high levels. Yes, oil has come down from some of its highs, but still at $75 a barrel, a lot of these companies are making a ton of cash flow. But as far as this fund goes, we're looking for companies that are trading below 1.5 price to sales. That fits the bill for many of these energy companies, and also companies that have momentum. And these stocks have performed over the last couple of years, and that they continue to be part of the portfolio. I would also say that with all this cash flow, a benefit is that they're returning to shareholders a lot of that. They're buying back stock, they're increasing dividends, and they're paying down debt, which makes them ultimately stronger balance sheets, stronger companies. So all that together, along with the valuation and the growth of earnings, is why there's such a large energy exposure in the fund.
And Josh, to go a little deeper on energy, the fund now has holdings up and down the energy value chain. How could this benefit shareholders over the next year?
Yeah, that's a great point. The fund is exposed to both exploration and production companies that are, as a result, heavily exposed to the price of oil, which, of late has been relatively subdued versus where it was about a year ago, but also downstream into the midstream companies. So EnLink and Plains GP Holdings provide great exposure to what's basically a toll road for oil and gas. And so they are less commodity price dependent and more just about volume. And I think right now, just generically, the oil implies that the end of oil is near, and that seems to be not the case. I mean, I think oil will be with us for a long time, for better or worse. And, and a lot of these oil companies can be part of the solution going forward, in terms of carbon capture and emission reduction. They have, some of the larger integrated names like Exxon, not in our fund, but just some of these larger names, have great R&D teams, and they're hard at work trying to come up with the next generation of solutions. So I think that, the last thing I'd mention, the price of oil seems to not factor in the idea of, any geopolitical risk that may surface in the coming year. So I think we're at a good spot, about 10 times earnings for the energy sector. So I think it's a great exposure to have in the fund.
So Ryan, after this most recent rebalance, the average market cap comes in at about $3.5 billion. How should investors look at that today?
Sure. Well, that's about typical for the fund. $3.5 billion is at the lower end of what you'd consider the mid cap stocks, mid cap range. Some small caps in there as well, but essentially this is a mid cap fund with a lot of mid cap companies. We like mid caps, so it's good to look at this fund as a way to play mid caps. Mid caps are a great place to invest. We think that a lot of individuals will have large exposure to the mega caps and the large caps through indexes or whatever, and then you might have some small caps, but sometimes the mid caps get overlooked. Mid caps actually are a great place to be. They outperform over the long term. If we look back to back 20 years ago, and each annual return for the past 20 years, mid caps have outperformed 60% of the time over large caps and small caps on any rolling 10-year period. So that's good performance. And they do so with less volatility than small caps. We also like the companies from a fundamental point of view. They're usually old enough to have a good track record, to have different business lines, to have a more diversified business model, yet still small enough that they can absolutely continue to grow organically, take market share, and even grow by acquiring other small caps or smaller mid caps as well. Speaking of acquiring, that's also a good reason to play this space as well. They are attractive to the large caps, and a lot of large caps will look into the mid cap space, take them out and roll them up, and it will make a difference to them. So all that together, and the way the fund is positioned, we just think it's a great place to be invested.
So Josh, why is the price to sales ratio such a valuable metric for this strategy?
Yeah, the price to sales ratio certainly imposes a lot of discipline on the fund. So 1.5 times sales is restrictive without a doubt. And price to sales, on a broad basis is a little bit unconventional. But I would point out, for sure, we eliminate some of the frothy names that, in good times it would be great to own. But I think more importantly, in bad times, they cause a lot of pain and perhaps the permanent, destruction of value. So I think that is important. I think what's also important is the idea that this construct brings in a lot of lower margin names. So I think in isolation, low margins are considered not to be the best. But I think what gets forgotten is that, low margins does not, really mean a lot. I mean, we have a lot of low margin companies with, high returns on equity and, attractive valuations and good growth prospects. So, I think, I call it the low margin anomaly. We have over a long period of time done quite well, trading in some of these lower margin names like grocery and industrials and energy. And I think at the heart of it lies the idea that these are established companies and established industries. Not a lot of competitors come in, because why would you, want to start up a company where there are high barriers to entry and maybe the margins aren't so robust. So I think that, the price to sales has served the fund very well. And I think it certainly is worth asking the question because it is unconventional.
So recently, Neil Hennessy, the founder of Hennessy Funds, was on CNBC, and he highlighted a couple of holdings from this fund. Ryan, one of the holdings he highlighted was Comfort Systems. What is the investment case for Comfort Systems?
Sure. Comfort Systems, it's, similar to what Josh was just describing. This is a company that installs and services and repairs HVAC systems. Obviously very important. Most people need some sort of heating or cooling in their house. This company also has a good commercial and industrial component to it as well. And when you look at it, that could also be, one of the reasons why it's done better more recently and why, it could do well in the future as well. There is something to be said for the growth in AI, the amount of networks and computers and cooling that requires. And there's a lot of that going on as well with this stock. So again, there's why it's in the fund. It's at a lower valuation, less than 1.5 price to sales. It's at about 1.4 times right now. And it's just it's got some good momentum behind it. And so you put all those together and, it's this type of company that is in our fund quite often and, can do well over time.
Josh, another name that Neil Hennessy highlighted on CNBC was Sprouts Farmers Market. What is the investment case for this portfolio for that holding?
Sure. Yeah. Sprouts, again, is a very kind of classic type holding. It's low margin grocery. And a lot of people, I think, don't think hard enough about grocery names, which I think over time have done quite well. And in Sprouts' case, very strong returns on equity and some very nice dependable growth. It fits obviously within our valuation and, earnings growth and momentum framework. I would also just highlight, it's a very defensive type name. Certainly if the economy slows, grocery, might not flourish, but certainly will hold up better than a lot of other types of businesses. And again, if there's a slowdown, people might eat at home more. I mean, there are lots of ways to spin that story, but I think that at the end of the day, it is a very solid business that resonates with customers and, has a healthy financial profile.
Well, gentlemen, thank you so much for your time for this update. To learn more about Hennessy Funds and the Hennessy Mid Cap 30 Fund, please visit hennessyfunds.com.